Hey everybody. Let's see, 2 o'clock on Tuesday. Just getting set up. Be ready to roll on this in just a minute. Let's see. Markets are up a little bit today after that big crash down yesterday. It's not terribly surprising. Lots of movement going on. It took a big hit. That was pretty impressive. And tonight we have Apple. So lots of interesting things going on. Today what we're talking about is understanding the Greeks. This is going to be a class on, just on the concepts of using the Greeks for understanding your options trades and using the Greeks to help you understand how the option prices move. Options are pretty complicated. They don't move in a straight line. They don't necessarily react in the same way all the time. And understanding the Greeks will help you really understand the trades a little bit better. So let me pull up the slides and we'll get going on that. All right, welcome to the presentation. This is Understanding the Greeks. And just one moment, we'll get going here. All right, the class is going to be on, as we said before, on the Greeks. So, and understanding the trades by understanding the Greeks. To the legal stuff first. First of all, ProEdge Trading is a community of traders seeking to educate and inform other traders about strategies, tactics, risks, and possible opportunities in options trading. All the topics we discuss are the opinions of the presenters and given for educational purposes. We are not financial advisors or registered brokers, and nothing in these presentations should be taken as advice to buy or sell securities of any type. Options trading can be complex and risky. It's advisable to practice any concepts discussed in these presentations using paper trading account. Please consult with a registered broker or financial advisor before placing any trades with real money. Past performance, actual or indicated by historical tests, is no guarantee of future performance or success. Okay. Hopefully the lawyers are appeased at this point. All right, so what are we talking about today? The fundamental concepts are that option prices don't move in a linear way. They don't move in a straight line, and even relating to their underlying stock. This makes them a little bit complex to understand. And to really effectively trade something, you have to understand it. Using the Greeks, we can understand what will happen to options prices when the markets change. So this is what I really want to help you come to grips with today. How do the Greeks describe how the price of the options are going to change? And when you're setting up a trade, how can those values, those Greeks values, theta, gamma, rho, delta, vega, all of those, how do those insight as to how you're going to make money from the trade? So we're going to go over what each of these things mean and a little bit of an understanding of who's each of the factors. So the Greeks are fundamentally values that are used to describe the sensitivity to change in the price of an option relative to the factors that drive an option's price. Now, I know that sounds complicated. Basically, it boils down to a couple of things. If the price moves, what happens to the option price? If the price of the stock moves, what happens to the options price? If time goes by, what happens to the options price? If implied volatility changes, what happens to the options price? Those are the fundamental simple things that we're going to be looking at here. It's not the simplest subject, but understanding these will definitely help you. Now, there are three major factors that drive the price of any option. Underlying price of the stock, and the Greek that relates to the underlying price of the stock is called delta. Perceived risks to the option, and this is implied volatility, and the Greek that relates to that is called vega. And the amount of time to expiration, and the Greek relating to that is called theta. Now, why did they use delta, vega, and theta? I'm not sure. To be honest, these things were numbers, or these things were things that come up with. These things were labels that were come up with from a bunch of academics, Black-Scholes, Merton. They derived some formulas that described the way that options prices moved, and since they were all PhDs, they wanted to make their papers sound very, very complicated. They used Greek letters as the designations for these. They probably could have used more descriptive names, but we've come to know them as the Greeks, so that's kind of what we're dealing with. Now, once we understand what the Greeks mean, you can actually use them pretty simply to create a what-if style analysis that helps us understand the trades that we're doing. And this is a really important thing. Since nothing in the options market moves in a straight line, it's really good to know what's going to happen if the market goes this way, if the market goes that way, if implied volatility goes up, if nothing happens and the value of my trade erodes away. What's going to happen in these cases? Understanding that allows you to create better trades. You can create a trade that takes advantage of something you expect to happen in a better way. You can create a trade that is safer, and you can create trades that have a better advantage for you. So the main Greeks we care about are the following. Delta, and delta is pretty simple. It's the change in the price of an option relative to a $1 change in the underlying stock price. So if delta is 15 cents, that means if the stock, and it's a call, that means if the stock price goes up $1, then the change of the option is going to go up 15 cents. Vega is implied volatility, is related to the volatility of the options. If the implied volatility goes up on an option by 1%, and Vega is 10 cents, that means that the price of the option goes up 10 cents for every 1% change in implied volatility. Now, if implied volatility goes down, the price of the option loses 10 cents. Pretty straightforward. We've got volatility on one side, and we've got the price of the option on the other. Vega tells us how those two relate to each other. Is another fairly basic one. It's time erosion. Now, we all know that options have a certain amount of time to live. That means that the longer an option has to live, the more valuable it is. There's more chance that if I'm buying an option, it's going to go in my favor over a long period of time than there is over a short period of time. Especially if there's a long distance to move between the current price of the stock and the price of your option. So options with far more time, length of time, have higher values, and then as you get closer and closer and closer to expiration, those values go down. What theta is a description of how many dollars is the price of this option going to go down between today and tomorrow. So that's another basic one. Really, although they sound really complicated, they're using Greek letters and they're talking about all these very complex formulas and things like that. The Greeks boil down to those basic things. What makes up the price of an option? And based on those three things, time, value of the underlying, and overall risk, I know what the options price is going to be by looking at my Greeks. Now, most trading platforms should have these on it. These aren't something you have to calculate out by hand. It's possible to do that, but you don't have to. So you don't have to deal with the big complicated formulas. Really, just being able to understand what the Greeks are and looking at your trading platform can give you a lot of hints about your trades. Now, there's something called second-order Greeks. These are the Greeks on the Greeks. And there's only one that I really want to talk about. I'm just going to briefly touch on it today because it probably deserves a lot of, it's a complicated subject, so it deserves an in and of itself. But second-order Greeks are descriptions of the way that the Greeks change, not the price of the option. And one of these Greeks is called, second-order Greeks is called gamma. Now, gamma is the rate of change in delta relative to the change in the underlying asset price. Now, why is this one important? Well, a lot of people, you can get by without using it, but it's a good risk detector for you. It tells you, if you map out what the gamma is across a bunch of price ranges, it tells you where the trade is going to be at risk when it moves into a certain zone. So it's just another way of looking at the trades. We probably won't touch on gamma too much. Like I said, it's very complicated. It's probably going to be more confusing than valuable, but we will talk about it a little bit. Now, just to be thorough here, I kind of put these on. This is the rest of the Greeks. Now, I didn't put these on to intimidate everybody. I didn't put these on to make it look like, super smart or anything like that. I'm going to just skim through these. When you get into options, there are a lot of academics who like to design different ways of analyzing options. They all get labeled with different Greeks. If you ever want to go back through these are all just on Wikipedia. But the only ones that really matter, I'd say, is rho. Is a measurement of the sensitivity to interest rates. Most of these are just completely useless, to be honest. There are some useful things about them, but for the most part, don't worry about it too much. There's a lot of Greeks. And so far, I've got 3 pages of them here. Everything from speed to ultima to zama to you name it. Now, are these useful? To us, probably not. Maybe somebody creating some big mathematical model or somebody who's trying to get their PhD. Those things might be useful. Probably want to warn you away from getting sucked into the idea of using too many of the second-order Greeks to monitor your trades. The main reason that the second-order Greeks are not very valuable, in my personal opinion, is that Greek values are estimates. And they can vary based on a lot of different factors, even very, very small factors. Results, you can see in one platform, the implied volatility on Thinkorswim might be slightly different from the implied volatility on TradeStation, might be different from the implied volatility on TradeMonster. All of these things can be different based on how you set up the model and how you're taking the measurements. Well, second-order Greeks, the VAMAs, the VAMAs, the charm, the color, the speed, all of those are Greeks on Greeks, which means they're estimates on estimates. And they can be very, very imprecise, and bluntly, they don't give you a lot of useful information. So my recommendation is to simplify your thinking and focus on the main ones. Now, what are the second-order Greeks really useful for? If I was still living up in Chicago, there's a couple of bars up there that are really great little traders bars. Usually the guys from the CBOE floor or the CME and places like that end up in these bars after work waiting for the train. And if you know some of the things like Charm, VAMA, VAMA, and things like that, you might be able to get a bet and get yourself a free beer. Outside of that, probably not. Okay. Last one. This is one that people always seem to be a little bit confused about. Implied volatility. Is it a Greek? No, it's not. Do we use it like a Greek? Kind of. Implied volatility is more of a fundamental factor of an options price. If you think about the price of the underlying and the time to the expiration of the options, implied volatility is basically equivalent to those. It is not a derivative. Implied volatility is the remainder of what's left over after you take time into account and the intrinsic value of the option into account. So technically, implied volatility isn't a Greek. It's the input for a lot of the different Greek calculations, though. Now let's get on to the good stuff. Delta, vega, and theta. Now I'm going to go over each of these. I'm going to talk about how they move relative to time and relative to different factors, and then we're going to look at them for a generalized understanding of using them for analyzing and constructing trades. Now, all of these things, delta, vega, and theta especially, should be available on pretty much all options trading platforms. If your options trading platform doesn't give you these numbers calculated out in real time, you probably want to think about a different platform because it's not giving you enough information to clearly do the trades. Delta first. Delta is a dollar value. You'll see it listed as 23 cents, negative 17 cents, negative 50 cents. Basically what it is that number says at the current underlying price, if the stock goes up by $1, the options price will change by X amount. If the delta on an option, let's say a call option, is 15 cents, then if that underlying stock goes up by $1, that option is going to go up by 15 cents. Now, that only holds true for the first dollar. The next dollar, it's going to change slightly. As you get into the money, the delta tends to go up faster. As you get out of the money, the delta tends to basically move towards zero. Now, delta on call options will always be a positive number between 0 and $1. Delta on put options will be a negative value between 0 and negative $1. Because for every $1 that the stock price goes up, the put options goes down in value. For every $1 that the stock price goes up, the call option goes up in value. Delta is just telling you how much that is. How much are you actually going to see for that price movement? Now, a few little notes. And by the way, I'm going to keep all of these slides are going to be posted on the website afterwards. Doug Reagan will be putting these up. And one of the things I wanted out of these slides is to have a good reference for anybody. Think of these as kind of note cards relating to the Greeks. Now, so here are some of the notes I've got. If the price of a stock or an underlying asset is at the money, that means that the stock price is right at the same price as the strike price for the option, then the delta for the option is roughly 50 cents. The reason for this is that assuming that we don't have any prediction on what direction the market's going to go, up or down, there's a 50-50 chance that the price of the stock will go below that or above it. It's literally the same chance of the stock price going up as it is going down. Now, that's not perfect, but it does explain why the delta for the option is roughly 50 cents. Because at any one moment, there's a 50-50 that this might be worth a lot of money, or the option might be worth a lot of money, or it might be worth no money. And you divide those in two, or just take the average of those, and that's 50 cents. So for every $1 an at-the-money option, for every $1 that the stock moves with an at-the-money option, you're going to get 50 cents in value. As it goes deeper and deeper in the money, it's going to start increasing. That delta is going to go up from 50 cents to 51 cents, 52 cents, 56, 8, all the way up to approaching $1. That'll be one-for-one relationship with the stock price. As it goes further out of the money, it gets smaller and smaller. It goes from 50 cents down to 49 cents, 40 cents, 30 cents, and starts drifting all the way down to close to 0 cents. So basically, the stock price would have to come way back up for it to move the option price at all. Now, another thing that I see people doing a lot, which is not a bad estimate, but it's something you've got to be a bit careful of. Delta is often used as an estimate of probability that a stock will close above a strike price at expiration, or actually will close out of the money at expiration. Above a stock price is probably, a strike price is probably not the best description. Now, so a delta of 15 cents is assumed to mean that there is a 15% chance the stock will close at or beyond that strike price at the expiration of the option. So let's say we've got a $35 stock. We have a $40 strike. A delta of 15 cents basically says that there's a 15% chance that the stock price is going to go above 40 and close at that point before the expiration. Well, that is okay as a rough estimate. and you can use it that way. It's always good to have tools where you can quickly understand things, but be very, very careful. If the implied volatility is very high, or actually if it's very low also, that can be very, very inaccurate. Implied volatility will change the way that delta, change the delta quite a bit. And so something with a high implied volatility that actually has a 15% chance of the stock price moving past a strike might show up with a delta of 2022, giving you the the idea that there's a higher risk that the stock price is going to move through that strike price. Remember, in most cases, implied volatility is overpriced, and that's going to inflate deltas, and it's going to give you a misimpression, a bad estimate of probability if you use deltas for the probability the stock will move through the price. Now, that doesn't necessarily mean it's something you shouldn't do. It's just something you need to be careful of if you need to be very, very accurate. You need to do forecast volatilities to figure that out if you want to be more accurate. So just be aware of that. Good tool, not always great. Now, a couple other things. Deltas change with time. So you can actually have the stock price stay exactly the same from day to day, and the deltas will still change on the options. The reason for this is you're looking at the probability of a price moving in the money or out of the money for a particular option, the underlying stock price. If there's less time, then there's less opportunity for that to actually happen. And their deltas will change because the probability of it happening changes. In the money options, when you get close to expiration, will start to increase or go out towards 1. Out of the money options will start to decrease. They'll start to go towards 0. So let's take a look at these. Now, this is a little chart that shows the way that the deltas move. Now, just so that you know, this is a weird chart. The 0.5 on the right-hand side is actually the furthest distance away from the expiration. This is a half a year away. And 0 is actually expiration, so this moves backwards. We're actually coming closer to expiration here. But you can see half a year out, the curve on delta is actually very, very smooth. It's almost a straight line. You know, as the price goes up, it goes further into the money, then you get almost an equal amount of increase in delta every day, or every time you get that move. As you get closer and closer and closer to expiration, and by the way, this right here is the middle, this delta starts going up at a steep rate, or down at a steeper rate. So for each price movement, the change in delta, which is actually the gamma number that we talked about before, gets more significant as we get closer and closer. Now, how does this really affect our trading? Well, one of the things is that if you're using a trade like a straddle or a strangle, which is relying on the change in deltas, then you can actually get more bang for your buck for the price move of the underlying stock by using a option that expires nearer than one that expires further down in the future. Now, I know this contradicts some of the other things, which is we want to avoid theta erosion. So these are all things that we have to understand and balance out as we design the trades. So something looking to make money from changing of deltas actually is going to make money faster when it gets closer to expiration than it would further and further out from expiration. The other thing is, if you're protecting yourself with options and you don't want to, let's say you're buying some options to protect yourself against a potential big movement, similar to the Batman style trades that we do. Options that are further from expiration, further out into the future, their delta is going to change less. for each dollar change. So you're going to get a little less protection from price movement if you buy long positions out there. The flip side of that is you're going to get less theta erosion, you're going to get less time erosion of them. So these things all balance out against each other. It's just really important to understand how these things shift around. Now, actually, let me go back. You'll notice that the calls, the delta is always between 0, which is right here, and 1. So as the price goes up, the delta goes up. Now let's take a look at the puts. Now it's between 0, which is up here, and -1. Same thing, same concepts as we talked about before, but the delta is always negative on a put. So, and it's basically the same thing. Further out in time, the deltas change a little less each time the price changes. Getting closer, the change in delta is steeper. So that means that the next dollar is going to go up faster than the first dollar. You know, we get a certain 15-cent movement out of this $1 price movement in the underlying stock. The next $1 price movement might be 20 cents. Next one might be 25 cents. Just understand that. Now, out way back in time, that same price series, so first dollar movement might be 15 cents. The next one might be 18 cents. The next one might be 22 cents. So you can see how the change is faster. And remember that the delta puts are just the opposite of the calls. Now, here's an interesting little thing about deltas. If you took two options, a put and a call, on the same strike, not the same strike, but the same stock at the same expiration and the same distance, strike price was same distance from the stock itself, and you basically took and you sold a put, which is going to have a delta of a negative amount, which gives you overall positive delta, and you bought a call, those two deltas are going to add up to 1. Now, what does this mean? A delta of 1 means that for every $1 price movement on the stock, the option position that you just took is going to have a $1 price movement, which means that you can actually trade a stock using what's called a synthetic. And this is what the basis of put-call parity is. So as the put deltas, as the price goes up, the put deltas would go down, but the call deltas would increase. And it will always keep the two of those at 1, basically creating a pure synthetic stock. It's the equivalent dollar-for-dollar value that you would get if you'd own that stock. But the interesting thing is you can usually get them for about 10% the price of the stocks. So just a very interesting trade. But it's also one of the, without getting into a whole lot of math and deriving formulas and things like that, it's actually also the basis for options pricing. You can never get those too far off. Now, you might be a cent or two here and there. You might even be 5 cents difference. But most of that's due to the spreads between the bid and the ask. You're never going to get the call and put so radically off from each other that you could create a synthetic position for less than the real position costs. What I mean by that is, if I could take and buy a call and add on to that a short put, and the two have deltas that add up to 1, that's the equivalent of a stock. If the cost of that was less than the basically the price of the stock minus the strike price, I could actually get into a position for free money. The market doesn't give out free money. And we could talk about this more at another time, but put-call parity, it's basically based on an arbitrage. If I could get the trade for a synthetic stock cheaper than the price of the stock itself, I mean, cheaper than the distance between the strike price of the synthetic and the price of the stock itself, I could actually have free money because I could sell the live stock, I could create a synthetic to buy it, and then it locks in the distance between the two. You won't see that work very often. And that's because the market actually works. There's very, very few opportunities for this to take place. But every once in a while you see a little bit of an edge. Won't be much, 5 cents maybe 6 cents, but definitely interesting thing. Now, all right, we already talked about the proxy for probability, so we don't need to get into that anymore. Let's see. Now, a couple of practical things using deltas. Now, and these are really why deltas were designed, or the formulas for delta, figuring out the delta of a position was created. By summing up the deltas of a position, we can see how the trade will react to the overall price movement. And I'm talking about the total deltas of the position. You can actually think of it in terms of if I've got the options equivalent of 1,000 shares, and my delta rate now is 15 cents, then I'm holding a position that's equivalent to 15% of 1,000 shares, 150 shares. It's the mathematical equivalent at that moment to owning 150 shares of the stock. It's just another way of looking at the trade to see where you stand. So if I'm playing a price movement and I know that I'm owning the equivalent of 150 shares of the stock and I expect the price to go up, I can see whether or not it's worth it to me. I can see if the price does go up, how does this change the price of my position? And also by analyzing the deltas at different price levels, we can see where the trade will change price quickly. That's actually a gamma analysis, but you can do it directly from delta also. So the other thing, and this is what comes into play with like hedge funds. You can use this concept to directly hedge out other positions. We can buy put options, and we can know how much of an underlying position we're hedging out. If we're long 10,000 shares of Apple and we want to protect ourselves against a downward movement, we can buy X number of contracts of puts, and using the delta, we know how much we're hedging against for a loss on that. Next one up is Vega. Actually, going back, does anybody have any questions on delta before we move on? Do you understand the concepts here? All right, we'll do a full question and answer session at the end. I just want to make sure that I'm not completely losing anybody before we move on here. Vega. Vega is the next one. Vega is a lot more important than most people realize. In fact, I use it for analyzing most of my trades, because Vega is the kind of hidden factor in a lot of trades. You can kind of get a sense, if the stock price moves up, then the delta is going to represent a change in the price of the option. That all makes perfect sense. I've got a call option. It's logical that the stock price moves up, my call price moves up. The one that's hidden from us most of the time is the implied volatility, and this is Vega. What Vega says, or the Vega is at this time and at the current level of implied volatility, if the implied volatility changes by 1%, the options price will change by X dollars. So if Vega is 8 cents and the implied volatility goes from 40% to 41%, the option price goes up by 8 cents. Now, that'll change slightly for the next 1%, but that's basically, it'll hold true for quite some time. Now, the interesting thing is Vega is positive for both puts and calls. So if the implied volatility in the market goes up, it doesn't matter what direction the stock price is moving, the puts and the calls relative to their other factors are both going to increase in value. If the implied volatility in the market goes down, both the puts and calls relative to their other values are going to decrease in value. So this is a very, very important thing to know, because sometimes we sit there, we've made a trade, and maybe we did something as simple as a long call. And we're far enough from expiration that time erosion isn't going to hurt us that bad every day. that suddenly the stock goes up, but the call option didn't go up. The call option actually went down in value. You're sitting there scratching your head. The price of the stock went up. Why isn't my call going up? Well, it's because the implied volatility died. It's the implied volatility dropped off because of some comforting news about the stock, and therefore, based on the Vega number, let's say it lost 3% implied volatility. Well, that's 3 times whatever the Vega number was, and that's what it lost. So that explains that. It helps us understand what's going on with the price of the option. And it's important to know because you don't want to be sitting there scratching your head as to why this trade is losing money, but it's going in the stock is going in the direction I expected it to. Well, you can kind of analyze the trades a little bit and see what's going on. Vega's a very, very important one for that. Now, another little thing, at equal distances from the underlying price, the strikes are equal distances from the underlying stock's price, options will have the same Vega. So if I've got a put option that's $5 below the current price of the stock, it's going to have a Vega of X. And if I have got a call option that's $5 a strike, $5 above the price of the stock, it's going to have a Vega of X also. The two are going to be the same. They balance each other off very well. Now, a few things to know about Vega. As you go in and out of the money on the options, Vegas change. Now, Vega has its highest point, its most significance right at the money. So if we have a stock that's $35 and I have a call option that is 35 strike, the Vega factor for that option is going to be the highest right at that point. So if the implied volatility goes up 1%, then whatever the Vega number is, the options price is going to go up by that amount. Now, if the price of the stock moves away from at the money, then the Vega value actually drops, and that's going in both directions. So the influence of implied volatility on an options price I'm not talking about deltas or anything like that, but the amount that implied volatility makes up the option price actually goes down as you get further away from at the money strike. And the other thing is this, and you'll see this by this kind of sloping down here. The amount of the level of Vega, or the influence of Vega, goes down as you get closer and closer to expiration. The reason for this is pretty simple. There's less time for things to happen, and therefore the implied volatility portion of a option is less. Therefore, the dollar value of Vega, the amount that implied volatility is going to change the price, is less. So as you get closer and closer and closer, Vega goes down. So if you're trying to do high Vega trades, if you're trying to do trades that take advantage of implied volatility going up or down, then you want to try to do them with as much time between the expiration, between you and the expiration as possible, between your options and them expiring. You don't want to be doing Vega trades right at the end of the expiration period because the Vega is not very high. It's not going to do much for you. Just kind of good little tips to keep in mind. Now, stupid facts about Vega. Vega is technically not a Greek letter, even though they call it a Greek. We consider it a Greek. And once again, if you go to those same trader bars in Chicago, you can get into arguments about Vega being a Greek or not. People get strangely passionate about that. I have no idea why. And as implied volatility increases, Vega will also increase. So this gives you an acceleration effect on volatility. When you're doing trades that are trying to take advantage of implied volatility going up, the nice thing about it is that as the implied volatility goes up, not only does that increase the price of the option, but Vega increases, so as it goes up more, it actually accelerates, and you can get a very, very profitable trade out of it. Now, Inverse is true. As implied volatility decreases, Vega also decreases. So just keep that in mind. How do we use Vega? Well, there's a bunch of ways to use Vega. In fact, I recommend that people start thinking about Vega on their trades because it really helps to give you insight as to what's going on in your trades. Since Vega shows us the effect of predicted or unpredicted changes in volatility on our positions, and implied volatility is one of the largest factors in an options price, we can use Vega to model what-if scenarios. Now, you see us, and I'll do a couple of practical exercises at the end of this, but you see us doing this all the time. When we look at things like the Batman trades, the trades that we would put on over an earnings announcement to try to capture the collapse in implied volatility, one of the things that I use is Vega to determine whether or not my protective options are going to basically erode the value of the trade so much that I can't make money. I need to know that if the implied volatility drops by X amount, what is the value of my protective trades going to be? Because that's going to determine whether or not I can make this trade. It's going to determine whether or not I can be profitable in this trade. If the Vega on that is too high, and the implied volatility drop that I expect is too much, then it doesn't matter what kind of great deal I can get on the upfront short options, because I'm going to lose money on the far options. Vega is the tool I use to understand that. And we'll go through some live exercises at the end of this and try to show that off and try to get an understanding of that. The other thing is, using Vega, we craft trades focused specifically on implied volatility. We can create trades that are, for the most part, delta new trades, or at least in the beginning, and we can basically try to craft, build a trade that has as much Vega as possible, and just use it to capture implied volatility. Some great trades. In fact, implied volatility can often be far more predictable and far more tradable than stock prices. You can pretty much see when implied volatility is mispriced. I can't really say that about stocks. So a lot of the trades that we do, even things as simple as iron condors, credit spreads, are actually using Vega to create trades that specifically target implied volatility. Now, credit spreads are also price directional, but they have a very, very significant Vega portion of them. Now, here's another thing that I'd like to get into people's heads. When you're trading, you're not trading one trade at a time. What you're doing is you're trying to take your entire portfolio of money and you're trying to make more money with it. Now, that's great. And one of the things that everybody always thinks about is risks of the trade, and risk of this and risk of that. Risks of individual trades is absolutely a good thing to think about, and individually managing risks on those trades is great. But you've got to understand there's also something called portfolio risk. Portfolio risk is, instead of having one trade go bad, just go bad out of a whole portfolio of trades, having all the trades go bad at the same time. That's a portfolio risk. Things that would cause that. Well, the other day we had a big crash down. What was it? We were down almost 200 points in the Dow. All of the stocks in the market were moving at the same time, and they were all moving together. If you had a large portfolio of, say, iron condors, then you would be sitting there, and a large number of your trades would be taking damaging, price movement against them. You can see that with Vega. You can actually sum up the Vega across all of your trades, and you can look at it and you can see how exposed you are to implied volatility changes in the entire market, or massive price movements in the entire market. Actually, delta is the same way. Are you overall long the market, or are you overall neutral the market, or short the market? Volatility, Vega, summing up across the portfolio. Are you overexposed to implied volatility going up or volatility going up, or are you not exposed or is shorted? You can use that to get a sense of where your portfolio is risk-wise, and always working to try to get that vega exposure for your entire portfolio down as low as possible is good. The reason for that is that we'd be taking a combination of long volatility trades, mixing them with short volatility trades, and one is going to have positive vega, the other one's going to have negative vega. You bring them together and it offsets the vega down towards zero. That tells you that if something crazy were to happen and the implied volatility would go through the roof, your portfolio is actually safe, because the ones with positive vega are going to be making money. The ones with negative vega are going to be losing money. The two combined is going to be relative. Now, getting a perfectly zero vega portfolio is a bit challenging, to say the least. But working towards keeping it as close to zero as possible is something that's a good habit to be in. If you've got too many iron condors at once, you may want to try to find some opportunities for doing long trades. So to do some long volatility trades, maybe debit spread, straddles, strangles, those types of things. Mixing those into your portfolio will reduce your exposure to overall market risks. The big whole market is shit all at once, implied volatility went through the roof, and suddenly you're sitting there with a terrible, terrible loss across the board. If you balance out, reduce your vegas to close to zero, you'll get a fraction of the loss, much more resilient portfolio. Now, here's another one, last of the biggies, theta. Theta is a dollar value, and it says between now and tomorrow, the price of this call or put is going to go down by X dollars. So let's say the call is $5, a theta value of 7 cents. The price of the call is going to probably open up tomorrow right around $4.93. It went down 7 cents. Hopefully I got my math right on that. Is always negative. It's negative for both long puts and long calls. And the other thing is, as the options expiration gets closer, theta becomes a larger negative value. This is the acceleration of theta. As you get closer and closer and closer to options expiration, the amount of value that you lose every day on a long option increases. This is called theta erosion or time erosion. Big factor in the trades. This is what offsets. This is what offsets the delta values in some ways. At closer and closer to the expiration of an option, the amount of implied volatility in the option gets far less significant, and the amount of actual sensitivity to price movement, the actual stock price moving, the delta, gets more significant. So as you get close to the end of the options expiration or end of the options life, each dollar of the price movement becomes more critical, and the implied volatility or presumed volatility of the option gets less critical. So that actually drops down the value of the options considerably, and that's your theta erosion. Now, characteristics of theta. Theta is highest at the money. So you're going to get the greatest amount of theta erosion on a daily basis right at the money. And this is the flip side of, once again, the vega, how vega is also highest at the money. The two of these are highest at the money because implied volatility is the most significant portion of the price at the money. So that's basically what you get. Now, if you get way out from the at the money price, let's say you've got a $35 stock and you've got a call option that you're buying with a $50 strike. Theta is actually going to be quite low on that. The further away from at the money you get, the lower theta is. And that goes in both directions. That's both going in the money and out of the money. It's as long as it's further and further away from the current price of the stock, the strike price is further away from the current price of the stock, the lower the effect theta will have on your portfolio. And once again, this is another one. You can sum it up across the entire portfolio and tell how sensitive your portfolio is on a daily basis to time erosion. And we want to minimize this, or we want to use it to our advantage. In the case of using this to our advantage, it's why we use credit spreads and iron condors on the last roughly 30 days of an option's life. Because as we get closer and closer and closer to that day when the options expire, theta gets increasingly bigger, more and more negative. Taking the price of the options down, we're short those options. We've got a short volatility trade. We just make money. Now, how do we use theta? Well, a couple of things. Using theta numbers, we can estimate how long we expect to hold a trade. Based on how long we expect to hold a trade, we can determine how much time erosion the trade will experience. If I know that for the next 10 days I plan on holding this trade, and that my total theta exposure for the entire portfolio is negative 8 cents a day, I've got 10 days times negative 8 cents. I know that overall I'm going to lose 80 cents in this for holding it those 10 days. Now, other things can happen to adjust that. Implied volatility can go up. The trade can go positive for, it might go intrinsic. There might be a number of reasons that the trade could go up. But it's going to go up 80 cents less than what I would have normally expected if theta was not taken into account. So for short periods of time, and especially for periods that are further away from the expiration date, 30 days and further back, you can do a pretty good estimate of what you're going to lose on a daily basis just by looking at the theta numbers. You add them all up. If the trade is short, then basically you've got a theta. If the trade is long, then you've got a negative theta, and it tells you how much you're going to lose each day on that. Now, gamma I'm not going to go into very deep because it gets into some very, very confusing subjects. It's probably not the, for day-to-day trading, it's probably not the most useful thing. But gamma is a second derivative of the options price. And gamma basically tells us how quickly delta will be based on the change in the underlying asset. So from $1 to $2 out of the money, that price change, how much is delta going to change? From $2 to $3 out of the money, how much is it going to change? If you've got a platform that can show you gamma levels, high gamma is typically beneficial to debit trades. If you've got a trade that you've basically spent money on, you've got a debit trade, you paid for it, then areas where you've got very, very high gamma are places where you're going to make money. Low gamma is beneficial to credit trades. We want as low a gamma as possible if we're doing something like a iron condor. The best advantage I can say for gamma is that it shows you hot spots where if the price moves to these levels, then the gamma will tell you that that's a dangerous place to be. For an example, let's say that you're close to expiration and you've held on to an iron condor for 30 days. If the stock price approaches either the short put or the short call, the gamma measurement is going to go up radically. Now, in that big flat spot in the middle, gamma is actually going to be very, very low. And that's what we want. We want to be right in the middle of that nice sweet spot in the middle of the iron condor trade. But as we get close to the short strike, gamma suddenly gets very, very high. And that's a warning sign that says that if we go any further in this, our position could be losing money very, very quickly. But gamma can actually be used for a lot of things, like determining places where you want to get out of a trade or make an adjustment on a trade. You don't want to let your gamma get too high on a short volatility trade like an iron condor. It can tell us that sweet spot, the area we have to hit for our trade. That's a long trade to start making money. Just it's a useful tool, but we'll probably have to set up some examples and really dig into it to see how it all works even better. And the other thing is Gamut can be a good early warning device. It tells you a little bit early when the dangerous areas of the trade are coming up. You know, if you're familiar with iron condors, you know that when you get close to those short strikes, the trade can start going against you very quickly at that point. So, like you said, early warning. Now, let's go over, just kind of sum up what we're talking about a little bit, and talk about summing. Using the Greeks, we can get an idea of where our entire portfolio is. Sum of all the deltas that we have, literally just taking the delta number times the number of contracts and adding that in and adding up all of our deltas gives us an idea of where our entire portfolio is in relationship to the market. If you've got a positive delta and the market goes up, you're likely to be making money. If you've got a negative delta, if the market goes up, you're likely to be losing. Theta, once again, we can use it at a portfolio level or a trade level. It tells you, if you add up all the thetas across all of your positions, it tells you how much you're going to be losing every day, how much position's going to be eroding. Now, you can neutralize theta also. A debit trade typically has a negative theta. A credit trade typically has a positive theta. So by knowing that, you can basically offset debit trades with credit trades and have a portfolio that's as close to zero on theta as possible, or sometimes even better, have positive theta so that it's really working in your favor. Iron condors give you positive theta. Vega, once again, balancing the portfolio, understanding how to level everything off based on your sensitivity to implied volatility. Just sum them up across everything. You can do it with a spreadsheet. Maybe I'll even put a spreadsheet together to do that. Now, what's the overall goal? Understanding these, once again, we want to figure out what happens if implied volatility goes up, what happens if the underlying prices change, and what happens if time passes. So these are the fundamental things that you use the Greeks for. All right. That was the hold on here. Just a second, I'm just trying to get iLink back up. Okay. All right. So, does anybody have any questions on those? And we can kind of play around with some of them. That was the end of the presentation itself. What questions does everybody have? Any thoughts? Please say something. You're awful quiet out there this afternoon. Okay, Bob, does it make sense to try to estimate the change in an option price if implied volatility drops 100%, if Vega starts to change immediately? Well, you've got to kind of take into consideration the situation. Something like the Batman trades that we're talking about, the short side of the trades. Now, just to bring everyone up to speed, the Batman trades are when we short a put and a call very, very close to expiration, and we do that just before an earnings announcement. The reason we do that is because the options are going to give us a very, very high premium or high implied volatility premium because the earnings announcement is coming up right away. I normally expect those to go all the way to zero. So I'm really not caring all that much about Vega on those. I'm most likely going to let those things go to expiration, and if not, they're not going to be worth a heck of a lot anyhow, just because the time value is going away so quickly. So I really wouldn't put a lot of effort into using Vega to understand those. But since I'm shorting these two, the short call and short put, on a potentially very risky situation, I need to protect myself. So I'm going out and I'm looking at protecting myself with a long option, probably the same strike call option, but further out in the future, 2, maybe 3 months out in the future, and a similar strike put option, and I'm going to buy those. I'm going to go long on those. Now, those are the ones that worry me. So what I want to do is I want to find out what is the potential implied volatility drop across those two long positions and multiply that times their Vega amount. Now, that's going to tell me if I do my estimates correctly. You know, if I estimate that the implied volatility on those are going to go from 40 down to 32. That's an implied volatility drop of 8%, and that's, you know, there's different ways we can get that number. Paul has done a great job of pulling those numbers out of Thinkorswim's Look Back or Think Back. Different ways we can estimate that. I can run those numbers and say, if I've got an 8% drop in implied volatility that I'm expecting on my protective options, and the Vega number across those two is a total of 10 cents, that means that I'm going to have an 80-cent drop in the value of my protective options. Well, I can very quickly see if 80 cents is bigger than the credit I'm getting from my short options, there's no way I should take that trade. Yes, Paul, Batman, I'm in a double calendar. Jose, with SBW, which is the best delta to go short on? Well, first of all, I'm not sure that you could ever tell there is no such thing as a best delta to go short on. But what is SBW? SBW. Setting buy rate. Okay. Okay. Now, I assume that when you're talking about that, you're talking about building out a synthetic and then selling either selling a call on it, or doing it in the opposite direction, doing a short synthetic and selling a put on it. Correct? This is something you'd have to talk to John about. Okay. First of all, I'm not sure there's a specific number that is the best one to go with. Remember, deltas are very, very sensitive to implied volatility. And if the implied volatility is very, very high, the answer to that question is going to be different from if the implied volatility is very, very low. Anytime you're doing something like a synthetic buy right or a synthetic, covered put, you want to have situations where the price movement is less than basically the implied volatility you're getting from the sold put or the sold call. In that case, I'd want to understand more about the implied volatility in the Vega more than I'd want to understand about the delta. So it's a very hard question for me to answer directly. Now, based on a person's trading style and the risks you're willing to take on, there's certainly levels that people consider are good trigger points. John would be the one to talk to about that. That's not a strategy I use a lot. So I'm going to refer you over to the expert. So hopefully that explained a little bit. So what other questions do we have on this? I know that this is really a theoretical class, but I'm more than happy to work through some examples or do anything that you guys want to do to understand Greeks a little bit better. So toss out some examples. Anyone out there? What we just talked about, does it make sense? Did it clear up any questions you might have? Okay. iLink does have a blackboard. I am horrible at writing on it. Okay. Do a credit spread. Let's see here. Let's see. All right, somebody lay out what's a trade that you have going on right now, and let's analyze it from a Greek's point of view. So somebody give me a trade. I can pull this up. This will help us a little bit. GWW, okay. What is GWW? Granger. I used to know Bob Granger, just from up in the Boston area. Very, very nice guy, very rich guy. All right, what kind of long May 33 call on BBT? Okay. All right. Let's just do, okay, Paul, let me just go with this long call first, and let's take a look at this. Long May. Okay, first of all, we know that the May has 24 days left. 33, we have a strike price that's on a call that's a little bit outside of the price of the stock right now. Hopefully TradeStation will catch up and catch up on this. Okay, great. Now, Bob, you're going to have to give me a little bit more information here. And Paul, I'll do your bullet point in just a second. So, Bob, BBT, we've got BB&T Corp. It's a bank, I believe. What do you expect? How long do you think you'd hold on to this trade, and what do you expect to happen over that period of time? Do we think that it's going to go up above 35? Do we think that it's going to go up above 30? Do we think that it's going to be flat? And over what period of time do you think that's going to happen? And this is for Bob on BBT. I'll tell you what. Let me just change me if you want, Bob. But okay. Okay. So let's figure out what it would take to make 100%. All right. Currently, the strike 33 strike. You're buying that for 25 cents. All right. You want to know. Your assumption right now is that you are going to be that you're going to make an extra 25 cents on this. So you want to exit at 50 cents. Using the Greeks, I can figure out what's it going to take to do that. Now, I know that the delta on this one is 25 cents. Okay, that actually makes it really simple. That means that if I have this in the short period, the short go from $31.81, it needs to go to $32.81 for me to make an additional 25 cents. That's what the delta just told me. So I can say that the delta is 25 cents. I'm trying to get 25 cents to make 100% on the trade. That means that in this case, I needed the stock price to move $1. If the delta on this was 12 cents or 12 and a half cents, I know that I needed to have that 12 and a half cents happen at least twice for me to get the amount of money. It would have to move at least $2. That's not 100% perfect because the deltas do change as you go further and further into the money or get closer to the money, but that's a really good quick estimate. So first thing we know, because the Greeks, is that to achieve your goal of making 100% of this trade, we need the stock price to go from $31.82 up to $32.82 as a rough estimate. Now, every day that you hold on to this, at least for the next several days, theta is going to eat into that trade. So I know right here that theta is a little over 1 cent. Let's just call it 1 cent. So I know that each day that I hold on to that long BBT position that you're talking about, the May expiration 33 call, I'm going to be losing 1.1 cents. Now, we are getting into the last 30 days, and this is going to start increasing a little bit. So if this movement of $1 doesn't happen, it doesn't happen quickly enough, I'm going to be losing 1.1 cents each day. So tomorrow it's going to be, this 25 cents is going to be worth 24 cents. The next day it's going to be worth 23 cents, 22, 21, and it's going to be going down in value. So I'm going to need a little bit more price movement every day in the future. If I hold on to this a week, I've lost nearly 7 cents on this trade, and that's what my theta told me. So I know from that, on a long call, 33 strike BBT, May expiration, I need this $1 price movement to happen pretty darn quickly. Now, I know that there might be some risk in the I know that there might be some risk in this. I also know that currently, let's take a look at BBT. Currently, the implied volatility on this particular option, this 33 strike May expiration, is 20%. Now, as a rough estimate, I'm going to say that it's not going to get below 18%. So, and that's just a real rough estimate. It's kind of a scientific wild-ass guess. But knowing that the implied volatility right now is 20.44%, and in my mind, the bottom, the floor that's likely to go is 18%. I know that there's 2.5% that that implied volatility could drop on this option. If it does do that, I want to know what the risk is to the price of my option because of that. Well, 2.5% times a vega of 2.6 cents, 0.026. I'm going to have to use a calculator on this one. My brain's not functioning really well right now. Okay, the vega number is 0.026. Currently, I see that we've got an implied volatility of 20.5. The bottom to that, in my mind, is 18%, so basically times 2.5. So times 2.5. That means that if that were to happen, I'm going to lose 6.5 cents on this trade. So immediately, if that vega risk was there, if the implied volatility did drop for some reason, I'm going to lose money, 6.5 cents. Now, if I see something that could increase the implied volatility, increase the risk of on that particular option, I also know that if I get 2.5% increase, that goes from 20.5 up to say 23% implied volatility, I just made 6.5 cents. So do you see how just on a very, very simple call option, it just explained a lot about what could happen? And it's just really using the numbers off of the screen right here. Now, that's an extremely simple example, but it's a good first step because what we're doing with a bull put, which Paul just laid out, is the same thing, but we're adding up what happened on both sides. It's these things all work together. So let's take a look at the bull put. Now, Paul, you're looking at GWW, Granger. Wow, Granger just dropped like a rock. Okay, let's see here. We're doing a 190 by 195 bull put. So we are short the 190, and we're long the we're short the 195, and we're long the 190. Small brain freeze there for a second. Let's just use the bid-ask midpoint prices, just because I'm just going to go simple on this one. We're going to get roughly a $1 credit between those two for taking $5 worth of risk. So $4 worth of overall risk once the credit offsets that. We want the price of this stock to go up. Now, we're holding on to this stock. This position is essentially a short Vega position. Let me point that out here. We've got, in this position, we have a long 190 put, which has got a 14.4 cents of long Vega. So let me just do 0.144. And we're short 195 put, the 195 strike put, and that's got a 17.7 cents in short, because if you're short the position, you basically just turn the sign around on number is. So Vega in this case is 17.7 cents. So minus 0.177 means that we're 3.3 cents short on Vega. So for every 1% increase in implied volatility, we're going to lose 3.3 cents on this bull put. So if the implied volatility goes up a lot, let's say it goes up from, let's see here, 190. Yeah, the average implied volatility is about 32%. Let's just say 32% between these two. If that average implied volatility goes up 10% to 42%, let's say there's some big risk out there, our position, which is short Vega of 3.3 cents, it's negative 3.3 cents of Vega times 10, is going to lose 33 cents. So out of that $1 of credit that we got, we just ate up 33 cents of it. Now, if we're holding this to the expiration, that won't really matter. But if we intend to get rid of this trade beforehand, and in a lot of cases for bull puts we do, we don't necessarily want to hold them all the way to the end, that means that we're going to be getting, we're going to have to overcome that. If the implied volatility increases, it's going to hurt our position. Now, let's take a look at some of the other things. Paul, 0.42. Did I mess something up there? What is the 0.424? Okay, 42 cents. I was just running with the numbers I have on the screen right now, which was a $1 credit. Okay, I'm just going to go with the numbers I have on my screen, Paul. Just want to show how you can analyze this. So the sensitivity, I just did a really quick analysis using the Vegas to determine the sensitivity of this trade to implied volatility. So we know that since we have a negative Vega, that increasing implied volatility hurts this particular trade. Now, let's take a look at some of the other factors. The theta on this is actually something that helps us. Every single day that we hold on to this trade, we're going to be, the value of the options are going to be losing money. Now, that hurts us on the long, the 190, but it helps us on the short, the 195. So let's take a look at what that effect actually is. The theta on the 195 is 11.4 cents, so 0.114. And that's a positive number because we're short. That's the 195 strike has a theta value of 0.115, 11.5 cents of 11.5 cents in our favor, positive number per day. Because remember, theta is negative, and since we're short this, we flip it around to positive. Now, we have the 190 strike put, which we're long, and that has 10.1 cents. 10.1 cents, negative 10.1 cents theta. And since it is long position, that is a negative number. So positive 11.4 minus 10.1. Now, not a lot, but we've come out with a positive theta number. It means every day on this particular position, it's going to go in our favor about 1.3 cents. Now, since theta increases as we get closer and closer to expiration, that will be going up. But at least we know in the very short term is that even if the price does not move on GWW, that bull put that we're in, that bull put spread, is going to actually start to make us money a little tiny bit at a time. Actually about 1.3 cents, 3% a day, just because of time erosion. And that's a good thing. I like to have that in my favor. So that's what I analyzed and understood from the Greeks about the bull put. And you can do that very simply. If this was my trade, is it scary? To a certain extent, yes. Granger just dropped a lot. Yeah, it's a bit scary. You're, currently underwater by. If you got into it at 42 cents, it's currently worth about $1. Yeah, it's scary. I'd be wanting that to come back a lot. Your risk is limited on it. I mean, it depends on how big you sized it. If you size this as a very small trade and you're willing to take a complete loss on it, you can let it run. But if it's a big trade, you're probably going to want to limit your losses. I have no idea what direction GWW is going to go in, so I'm not picking any directions at all on this. I'm just saying that it's getting to the point where it's closer to causing you more pain than you might want. Now, every day that you hold on to this is going to basically make it better by 1.3 cents. So if the stock price doesn't move, that's a good thing. Now, we took a look at how it's sensitive to volatility. We took a look at how it's sensitive to the theta. We know what's going to happen as every day passes. The other thing we can do is see where we stand on delta. All right, so right now, the delta on the 190 long puts is negative 21.3. The delta on the 195s is negative 30.7, but since we're short on this, that means it's positive 30.7. So let's see what we are for. Let's see where we are for delta on this one. So 0.307. That's the positive delta that we have on our short put, minus 0.212 means that we're 9.5 cents positive delta, a 0.095. So every $1 that Granger goes up, we're going to be making down our trade. It's going to benefit our trade by 9.5 cents. So for us to get back, just purely from a delta point of view, for us to get back to that 42 cents, or basically earn back our, let's say our 50 cents, we need Granger to go up. Let me see. We want to get back to even. It's 58 cents. Okay. 0.58 divided by 0.095. Right now from deltas, and this will shift a little bit, so this isn't a perfect number, it's just an estimate. If Granger moves back up to 208, 208.81 or 80, then Paul, your position is going to be back at 42 cents, which is where you started. So I know basically what we have to hit before your position is back at break even. Now, that's not taking into account any changes in volatility. It's not to count any time erosion. It's just saying that today, if the price moved, it would have to hit 208, which is $6.10. 208. It'd have to go up $6.10 for your position to be back where it was when you started. So did you see how I got to that number? I figured out what is the net delta here, and then I figured out how much the price of the option needed to change, so I can use the net deltas, which is the amount of change per $1 price movement, to figure out how much price movement do I need to get to have my position come back. So you see the value of using the Greeks for understanding the position, for to see what's going to happen in the position. And actually, specifically on that example, hit me with questions, because I'd love to make sure that everybody understands what we're talking about. Does anybody else have some trades that we want to take a quick look at? Anyone? Well, we can. It's about 3:30 right now. We can wrap this up. Some kind of volatility drop play. Okay. Let's see here. Well, I mean, the Batman trades are probably some of the best ones to do that. Okay, John. Actually, that fits into this a vol drop play. So, John, what is your the Batman question? And maybe we can turn this into. Okay. Paul, I think that John is about to ask a question that relates to this. So let me just wait for John to bring his up. Looking at Amazon. Okay. Let's take a look at Amazon. Okay, John. Yes, volatility drop is bad for long calendars. So, what do you want to know? Okay, what's the trade that you want to look at, though? And I guess that's what I need to know. First of all, Amazon is announcing when? Is it tonight or tomorrow night? It's the next. Is it short term, right? Okay, 200, 175. And what day is Amazon? That's in the next couple of days, correct? And I'm assuming that we're using the weekly expirations, weekly to June's. Okay. All right. Let's take a look at this. All right. First of all, the thing we need to do is figure out what is the credit that we're getting on the 200s by 175s on the short weeklies. So currently the price of Amazon is $189.26. The credit that we're going to get on the 200 call is $2.20. And the 175 put is $1.56. So $2.20 plus $1.56. Now, we've got 3 days left for this thing, for the options to expire on these weeklies. Now, since we've such a short period of time, I'm basically considering them, if the trade goes well, as worthless. You know, I'm making the assumption that we actually have a full $3.76 that we're going to receive for that trade. Now, I look at that as kind of a budget. I've received $3.76 worth of credit. I have the ability to protect myself with up to that amount. Now, we want to take a look at a couple of things. First of all, the implied volatility of those is 85% on the 200 strikes, and it is 93% on the puts. Okay, those are pretty high. What is a normal number for implied volatility? We can take a look at Apple in just a second too, Jai. What's a normal number for implied volatility? Because remember, after this announcement happens, the implied volatility is going to drop down to whatever its normal rates are. And if its normal number is 30, then we know that we've got a potential drop down to 30. If the normal number is 25, then we've got to drop from whatever we're at to 25. Once again, I'm not worried about the short month, because those are such short time frames that theta erosion is going to take over. The value of those is going to go basically to whatever the intrinsic value is very, very quickly. The one I really want to know about is, if nothing happens, how much am I going to, if nothing happens with the price of the stock, what am I going to get for vega erosion on the protective ones? So taking a look at this, I see that the implied volatility is 38% on the 175 puts. This is the June expiration. And on the 200 puts, it's 35%. I'm just going to average the two of those and say that the average is 37%. I'm just pulling a number off the top of my head here. Do we believe that the drop in implied volatility is going to go down to 30%? Well, that might be a reasonable assumption. That's 30% right about there. If anybody has a better estimate, please let me know. But right now, I'm going to use 30% as my number. Now, I just estimated out that the average implied volatility of the 175 put and the 200 strike call was about 37%. If I think that the average of those two is going to drop down to 30%, it means I'm dropping it by 7% implied volatility. 37% minus 30%, which I think is where it's going to, the difference is 7%. I'm going to look at the vega on the 200 strike call, and that's 26.9 cents. Okay. Okay, first of all, please remember this number. Please remember that we've got $3.76 in credit. We need to make sure that the loss that we take because of this implied volatility drop is going to be less than $3.76. All right. So 200 strike call, my vega is 26.9. 26.9 cents. That's per 1% implied volatility drop. The 175 has a 23.5 cents. All right. So 0.269 plus 0.235. So I know right now that every 1% drop in implied volatility is going to get us a 50 cent loss on our protective options. So my estimate was that we're going to drop by 7%, so times 50.4 cents times 7, $3.52. Okay. So here's the assumptions I'm using to make this analysis. If the price does not gap up or down, and we just get the drop of implied volatility down from 37% on average in our protective month down to 30% on average, those options are going to lose $3.52. Remember, we got a credit of $3.76. So if nothing changes right now, this is our risk at the midpoint of this trade. If nothing changes, we're still about 24 cents in the positive. Now, I don't like that. That's a little tight for me, but it's not too bad. At least I won't, as long as my assumptions are correct, I won't lose money on this trade because the implied volatility drop on the protective options. And remember, we are going to get an implied volatility drop, and that's what we got to protect. It's one of the things we've got to do to protect ourselves. Now, the flip side of that is that as the price moves up or down towards 175 or towards 200, the deltas are going to start to move in our favor on these, and we're going to actually start to get an increase in value of those options, just like it's a long strangle. So that will be good. So what we really want to see happen on this trade is movement towards either 200 or 175. In fact, closing out Friday evening at either of these two numbers would be just about the perfect trade. So just some things to think about. Now, on top of that implied volatility drop, let's look at what we're going to lose for value for holding this trade for those 3 days. On the 200 strike June protective options, we're going to lose 9.1 cents a day. On the 175 strike put, we're going to lose 8.6. So 3.52 is what we lost from the drop in implied volatility. And we're going to lose a little bit for holding this each day. 0.091 on the call side. Whoops. And 0.086 on the put side. So we're going to lose 17 cents a day holding this till Friday afternoon. Actually, technically at this point, it's more like, about 3 days. So times 3 days, we're going to lose an additional 53 cents holding at that period. Now, we need to figure out if it's worth it. Now, we will be making more money if the stock price moves close to 175 or close to 200. And doing out all the complex analysis to figure out exactly how much would make at each of those points based on the implied volatility drop and things like that is probably a little more than I can do in this class. But I at least have a couple of things that I now know. If I'm going to lose 53 cents from time erosion, and I'm going to lose potentially $3.52 from the implied volatility going down if it goes down to the expected value of 30%. So that tells me that if those two things happen, if the stock price does not move at all, then I'm going to lose a little tiny bit on this trade. I'm going to basically lose a little bit more than my $3.76 budget that I had from the credits. Now, that doesn't mean this is a bad trade. It just means that for this thing to make money, we have to have it move towards the 175 or towards the 200 strike. Remember, those two peaks are where it's going to make the most amount of money. So, John, did that analysis make sense? Did you see how I used the theta and the vega to figure that out? You have to put into the mix an estimate of where you think the implied volatility is going, but at least you have a sense. Right. Now, remember, MMM is right, is $11, but that doesn't guarantee you it's going to move. I want to know one of the things I'm a big fan of is knowing what's going to happen if this fails. If this fails right in the middle, if literally Amazon does not move an inch, it closes at 189.39 and opens at 189.40, then you're going to be down about 30 cents. So now what's really important about that, though, is when you're deciding which options you're going to use to protect yourself. If we go in and use the Mays, let's just do a really quick comparison here. All right. The implied volatility on the 175 put is 45. Now, remember, our expectation is that the implied volatility of all of these is going to essentially collapse all the way down to 30. Now, that won't happen on the weeklies because they're too short term. But on anything longer than the weeklies, it's going to come down to a number pretty close to our guesstimate of 30%. So that means that this is going to drop almost 15%, not 7%. And the 200 strike is going to drop, let's see, 45. 200 strike is about 42. Let's just say 43.50 is the average implied volatility. So that's going to drop 13.5%. Let's take the Vega numbers. Vega for the 200 strike May expiration, this is a closer expiration, is 17 cents. So 7.6. The 175 strike is 14.7 cents. Okay, so we know that on the May expiration, we're going to lose 32.3 cents per 1% implied volatility drop. The average implied volatility of these two positions is about 43.5. We believe that that's going to go down to 30. So that means we've got a 13.5% drop. So 32 cents times 13.5 means that on that one, even though our Vega numbers themselves were smaller, the greater drop is going to cause a greater amount of loss because of the volatility. So this right here tells me I would not want to use the May expirations as my backing for this trade. It's just too big of a loss. Even though the Vega is lower. But remember, John, the Vega is lower overall, but that you still have to multiply it times the percentage drop that you expect to get. The implied volatility is higher. So on the Junes, the average implied volatility is 37%. That's only a 7% drop. We're still both going down to 30. On the Mays, the implied volatility, because it's closer to the event that's happening, is higher, and we've got nearly a 13.5% volatility drop. So 13.5% times, what was it, 32 or 33 cents is higher than 7% times 50 cents. So you see how those two numbers kind of came together and gave you an explanation of what could happen, and it tells you pretty quickly that the Junes are the better options to trade? Good, good. That's what I'm hoping for. And I want to get people thinking in these terms because it lets you see the trade. Because it's really easy to lay out this trade and say, sure, I'm going to use May as my protective month. Well, May may not be the right protective month. June might be better. In fact, I mean, if you're willing to pay for it, you could even go out to July or August and potentially do those. Let's see, 175 has a 36% by 32%. I mean, that rate there may even be better. It might only have a 4% drop in implied volatility. So just some things to think about. All right. I need to wrap up some trading. I really do need to step away because I have some stuff I've got to take care of before the end of the day here. Are there any final questions? And hopefully this was a good session for everybody. People got something out of it. I'm going to be posting the slides, so you'll have access to those slides. And the recordings will be available on the site. Is there anything else before we wrap up? Thanks, Paul. Thanks, John, everybody. Jai, I'm sorry I didn't get to Apple. There's very, it's going to be hard for me to do that in the couple of minutes, and I really have to get closing up here. But if you take a look and do what I just did, you can kind of do the same analysis for yourself on Apple. And by the way, yes, I think Apple may be a potentially good trade, but there's a lot of risk that could gap significantly. Apple is under a lot of pressure. Anybody have the MMM number for Apple right now? I'm guessing it's probably about 55, 50 to 55 maybe. Only 30. I don't know. I'm disagreeing with that one. I'm saying 50 at least. Think about what's going on with Apple right now. Both AT&T and Verizon announced that the sales on their cell phones, especially their higher-end cell phones, has been significantly down over the last quarter. There is an enormous amount of pressure on Apple price-wise because of this run-up that they've had, the overbought position that they've been in. We've been this fairly significant drop, and now we're, I'm worried that MMM number is just not right. I would be very careful about taking a Batman-style trade much closer than $45 either direction on Apple. I'd say 50 is probably about where I'd be looking at. Okay. Motorola canceled one of their new projects for AT&T. Is that Motorola Mobile that's now owned by Google, or is that Motorola proper? Okay, Motorola Mobile. All right, good. Insider trading. Come on, Paul. Keep getting the dirt. All right, everybody. I'm really running short on time here. I apologize to cut out, but did you get something out of the class today? Ouch, that's painful. All right, thanks everybody. I appreciate it. Like I said, all the stuff will be up, and I will see you on Wednesday morning, tomorrow morning. All right, thanks. Bye, everyone.